As we stand here on Sunday evening, January 11th, 2026, the market is currently closed. The final closing price for Pfizer Inc., trading under the ticker PFE on the New York Stock Exchange, was $25.48 USD as of the session end on Friday, January 9th. This represented an intraday increase of 0.19 or 0.75% on the day. While a sub-1% move might seem like a quiet Friday for most, for Pfizer, it is part of a much larger and more complex narrative that has been building since the start of the new year. Investors have been watching this ticker with a mix of exhaustion and cautious hope as the company attempts to move past its post-pandemic identity crisis. The immediate reality that caught many by surprise this week was the significant institutional activity despite the relatively flat price action. Large blocks of shares moved through platforms like Interactive Brokers and the Interactive Brokers trading desk, suggesting that while retail sentiment remains split, the big players are positioning themselves for a very specific 2026 catalyst. The common market narrative for Pfizer is that it is a giant in decline, a company that caught lightning in a bottle with its COVID-19 vaccine and has since struggled to find its footing. You see this sentiment reflected everywhere, from the Robinhood app to the various investing sites where retail traders discuss their individual brokerage accounts. The expectation was that by 2026, Pfizer would have already successfully pivoted its massive cash reserves into a dominant position in the obesity market. However, the reality is far more nuanced and, quite frankly, a bit more difficult to digest. Instead of a smooth transition, we have seen a series of clinical setbacks, particularly with their internal oral GLP-1 programs, which have forced the company into an aggressive and expensive acquisition mode. This tension between the expectation of internal innovation and the reality of forced external growth is what is currently driving the volatility in the stock. If you look at the recent trading volume, it is clear that people are starting to treat Pfizer less like a growth play and more like a value trap or a high-yield income play. When you open your Fidelity mobile app or check your SoFi investing dashboard, the first thing that jumps out is that massive 6.75% dividend yield. For many, that yield is the only thing keeping them in the stock. But here's the angle most people are missing. Pfizer is currently undergoing one of the largest cost realignment programs in the history of the pharmaceutical industry. They're looking to shave off billions in expenses by 2027, and we're starting to see the first real signs of that efficiency hitting the bottom line in the early 2026 projections. While the headline revenue guidance of $59.5 to $62.5 billion for the year feels underwhelming compared to the $100 billion heights of the past, the operational efficiency is what might actually save the stock from further decline. Institutional activity has been particularly interesting over the last few sessions. Data from various Fidelity brokerage reports and Interactive Brokers platform metrics indicate that while some hedge funds are trimming their exposure to traditional pharma, others are using the current $25.48 price point as a long-term entry. They're looking at the PEG ratio, which is currently sitting at a remarkably low 0.12. This suggests that the market might be significantly underpricing the long-term growth prospects of the new oncology-heavy pipeline. When you compare this to the premium valuations we see in something like Nvidia stock or even the steady climb of Apple stock, Pfizer looks like it is living in a different universe. This valuation gap is where the opportunity or the risk lies for anyone involved in self-investing today. Before we go any further into the pipeline, I want to hear from you. Comment below how many shares of Pfizer Inc. you currently hold in your portfolio. Are you holding for the dividend, or are you waiting for a specific clinical trial result to bail you out? The reality of the recent price action is also tied to the macro environment. As we watch the broader indices, Pfizer often moves in a counter-cyclical fashion. When the high-flying tech names like Tesla stock take a breather, defensive names sometimes see a bit of a bid. But Pfizer has not been a typical defensive stock lately. It has behaved more like a biotech startup with the baggage of a legacy conglomerate. This is largely because of the Metsera acquisition. By spending billions to acquire Metsera in late 2025, Pfizer essentially admitted that its internal efforts to compete with Eli Lilly and Novo Nordisk were not enough. The market reacted to this with a collective shrug, but the real test comes in the next few months as we get the Phase 2b data for the injectable and oral candidates they picked up in that deal. For those using Schwab Intelligent Portfolios or other robo-advisor services, you might have noticed your allocation to healthcare shifting. This is because the risk profile of companies like Pfizer is changing. We're no longer looking at a steady, predictable blue chip. We're looking at a company that is fighting for its life in the oncology and obesity space. The Seagen acquisition was supposed to be the pillar of this new era, yet the integration has been slower and more expensive than many anticipated. The reality is that the $43 billion spent on Seagen needs to start producing blockbuster results soon to justify the debt load Pfizer has taken on. This is a point of contention often discussed among those looking for investment help on professional fidelity wealth management platforms. Let's look at the business model for a second because it is important to understand where the $25.48 price point actually comes from. Pfizer operates as a global biopharmaceutical company, but its revenue is increasingly reliant on a few key areas: oncology, immunology, and whatever remains of its primary care and vaccine business. The older reports showed a massive reliance on Comirnaty and Paxlovid, but those revenue streams are now essentially a baseline rather than a growth driver. The 2026 guidance reflects a further $1.5 billion decline in COVID-related sales. This was expected, but the reality that the company also faces a $1.5 billion hit from patent expirations, the so-called patent cliff, is what makes the situation so precarious. When blockbuster drugs lose exclusivity, the revenue falls off a cliff and the generic competitors rush in to fill the void. If you're using a Robinhood trading account to buy fractional shares of PFE, you're likely looking at the low cost of entry, but the smart money is looking at the research and development spend, which is projected to be between $10.5 and $11.5 billion for 2026. That's a staggering amount of capital being deployed into the pipeline. This is where the tension between expectation and reality becomes most visible. The market expects that with that level of spending, Pfizer should be able to produce the next Wegovy or the next major cancer breakthrough. The reality is that drug development is a game of high failure rates. We saw this with danuglipron, their internal oral obesity drug that was essentially scrapped due to safety concerns and dosing issues. Those are the kinds of events that lead to the sharp drops you see on your SoFi trading platform. The institutional ownership shift is another layer to this. Large firms like Vanguard and BlackRock still hold massive positions, but we're seeing a rotation among active managers. Some are moving their capital into SoFi ETFs or Fidelity ETFs that focus on high-growth biotech rather than broad-based pharma. This selling pressure has made it difficult for PFE to maintain any momentum above the $30 mark. Every time it tries to rally, a wave of institutional selling seems to meet it. This is why the stock has remained in this narrow range. But for those focused on online investing for the long haul, this consolidation phase is often where the most significant positions are built. What about the future outlook? If we look at the potential catalysts for the rest of 2026, it all comes down to clinical trial data. The expectation is that the Metsera assets will show competitive weight loss and better tolerability than the current market leaders. If the data matches that, Pfizer could easily see a 20 to 30% re-rating. If the data is mediocre, the stock likely continues to trade like a bond, propped up only by its dividend yield. There is also the political element to consider. With discussions around drug price negotiations and government legislation always in the air, the entire sector is under a cloud of regulatory uncertainty. This is why many people seeking online investment advice are being told to diversify into other sectors or use an intelligent portfolio to manage the risk. Comparing Pfizer's trajectory to other major players provides some perspective. While names like Nvidia stock have redefined what growth looks like in 2026 and Apple stock continues to be the bedrock of many portfolios, Pfizer represents the old guard trying to reinvent itself. It's a slow, methodical process that doesn't always provide the instant gratification that modern traders on the Robinhood app are looking for. It requires a level of patience that is becoming rare in today's fast-paced market. This is where individual brokerage strategies differ. Some prefer the active investing approach offered by the SoFi active investing platform, where they can jump in and out of positions based on headlines. Others prefer the steady, long-term approach of Fidelity mutual funds or Fidelity IRAs. The reality